and I'm going to go to chapter 11. So we covered chapter 10 last week. Chapter 11 is about differential analysis and decision making. Let's go to exercise and do a few problems there. And here is the exercise. Okay, so I'm gonna start from problem number 1. Should be easy for you. Let's start from number 2. So the company manufactures 3 types of bicycles: dirt bike, mountain bike, and racing bike. Data on sales and expenses for the past quarter follows, as you see. So I see they are selling $90,000 of dirt bike. Mountain bike, they are selling more, $150,000, and racing bikes, $60,000. Every one of them has a positive contribution margin. It looks like mountain bike has the highest contribution margin and racing bike has the lowest. And they have some fixed expenses, traceable advertising for each bike. They have some depreciation on special equipment for each category of production. Salaries, product line managers, those are fixed expenses, traceable again. Allocated common fixed expense. Okay, that's allocated. Common fixed expenses normally can be allocated to each department to some degree based on some cost driver. But overall, remember, it's a common fixed expense. It's not traceable. So after doing that, you will see that the net operating income for each bike shows positive for dirt bike, positive for mountain bike, and negative for racing bike. Okay. Now, the issue is the way that you are looking right now here, the racing bike looks bad. Okay. But it's not a good way to demonstrate the information, because the common fixed expenses cannot get deleted if you get rid of, let's say, racing bikes. So common fixed expense is common. It's going to happen no matter what. So that should not be considered as a form of judgment about, let's say, racing bike in here. Now, it says management is concerned about the continued losses shown by racing bikes and wants a recommendation as to whether or not the line should be discontinued, just because the racing bike, as you see here, it's a negative, right? So the management has the issue. But as I said, you put the common fixed expenses in here, that's why the racing bike looks bad in here, right? But remember, common fixed expense is going to happen no matter what you do. So the special equipment used to produce racing bikes has no resale value and does not wear out. Okay, so racing bike has no equipment that relates to racing bike has no resale value. What is the financial advantage or disadvantage per quarter for discontinuing the racing bikes? Should the production and sale of racing bikes be discontinued? And prepare a properly formatted segmented income statement that would be more useful to management in assessing the long-run profitability of the various product lines. So let's look at the solution that I have here. So the financial advantage of discontinuing the racing bike is computed as follows. Last contribution margin is $27,000. If you look at here, see that contribution margin right there? That contribution margin will go away if you discontinue racing bikes. And what is contribution margin doing? Contribution margin, it's a dollar amount that helps you to pay for the fixed expenses, right? Specifically, fixed expenses that is traceable in here. And also the common fixed expense that is not traceable, but it's going to happen no matter what, right? So if you discontinue racing bikes, the contribution margin will go away. That's minus 27. You can save something like advertising that is traceable to a racing bike. That's $6,000. You can also save salary of product line manager. That's $10,000. Let me show you one more time. So here you see that $6,000, you can save it if you discontinue. You cannot save the depreciation. Depreciation will happen no matter what because you already purchased the equipment, has no resale value, and it will happen. But next thing you can save is the line manager. So you can save the $6,000 and you can save the line manager. Okay. Depreciation will happen no matter what. And common allocated fixed expense will happen no matter what. So all you can save by discontinuation of this racing bike is just $11,000. But your contribution margin is 16,000, and your contribution is 27. So 27 minus 16, you have a deficit of 11,000. So why you're gonna lose that $11,000 since you can just save 16? So 27 minus 16, you will be worse situation by 11,000. You don't want that. So the depreciation of the equipment is a sunk cost and is not relevant to the decision making. The common costs are allocated and will continue regardless of whether or not racing bikes are discontinued. Therefore, they are not relevant to the decision. So those two are out of our calculation. The only thing is left in here that is relevant is advertising and salary of the product line manager. That's it. So this is an alternative solution for this. If you like to look at it, is just providing you the same information. Let's do maybe for segment reporting, this is how I like you to prepare a segment report that will be more useful to managers instead of the one that is given to you in the book. In the book, it says common cost is allocated, but that's fine. But technically, common cost is going to happen no matter what. So you have to look at your contribution margin of, let's say, every single product, which is positive. And then you have some related fixed expenses that is traceable. Okay. And then you have product line segment margin. As you see, the product line segment margin for every single product is still positive, right? And that positive product line segment margin will definitely help you to pay the common fixed expenses. So remember, common fixed expense will happen no matter what. So you have a product line segment margin of positive number. You have a contribution margin of positive number. So you want technically keep that racing bike because it will help you to pay also for common fixed expenses. Okay, that was a good way to show to management what's going on in reality. So number 3, it's a buy and make decision. So it's good. It's going to be a good problem. So let's look at number 3. So the company manufactures a variety of engines for use in heavy equipment. The company has always produced all the necessary parts for its engines, including all of the carburetors. An outside supplier has offered to sell one type of carburetor to Troy for a cost of just $35. To evaluate this offer, Troy has gathered the following information relating to its own cost of producing the carburetor internally. So they have direct material cost of $14, labor of $10, variable manufacturing overhead of $3, fixed manufacturing overhead traceable is $6, fixed manufacturing overhead allocated is $9. Again, allocated, that means that $9 will happen no matter what. The cost is $42 for the company, as you see in general, and they need 15,000 units per year. So 1/3 supervisor's salary, when we say here $6, 1/3 is supervisor's salary, which can be avoided, is relevant. 2/3 depreciation of special equipment, no resale value. That means 2/3 of this $6 is not relevant, because you cannot avoid it. It's gonna depreciate it anyway, and there is no resale value. So just 1/3 of this $6 can be avoided, and it's relevant. Now, assuming the company has no alternative use for facility, they are now being used to produce the carburetor. So they don't have any other alternative to use that area. That's the assumption. What would be financial advantage or disadvantage of buying 15,000 units of carburetors from the outside supplier? Okay, so let's do that first. So cost of purchasing is 15,000 units, $35 per unit. That costs us, if we buy from outside, $525,000. If we wanted to make it inside, we have to pay for direct material. We have to pay for direct labor. Variable manufacturing overhead will happen no matter what. And $2 traceable fixed manufacturing overhead, that's 30 times 15,000 units, that's $30. That's the actual cost that we really need to pay if we want to produce inside, okay? And the $2 comes from here again. 1/3 of supervisor salary, we have to pay that. The other $4 from this $6 is depreciation, which will happen no matter what. So really what you are paying is, you are paying for direct material, direct labor, variable manufacturing overhead, and $2 for supervisory salary. That's what you are really paying. So if you do that, the cost will be $435,000 compared to purchase price of $525,000. That's $90,000 less, and definitely we like to make it inside instead of from outside. Okay. So based on the data, companies should reject the purchasing of this carburetor from outside. Now let's see what is number 3. The section 3 of this question says, suppose that if carburetors were purchased, Troy could use the free capacity to launch a new product. Okay, that's a different story now. The segment margin of the new product would be $150,000 segment margin, which is considerable money, right? Given this new assumption, what would be the financial advantage of buying 15,000 carburetors? So let's put the calculation next to each other. So if we make it, we have to pay $435,000, which we already calculated here. And we also give up a potential opportunity cost of $150,000 for that lost capacity, right? So technically our cost, if we want to make it, then it ends up to be 585. And that's not good because we can just buy it by 525. So that will be $60,000 saving. And that's an advantage. And we would accept the offer in that situation. Okay. So those are two different scenarios, scenario 1, scenario 2, and you are considering which one is advantage or disadvantage. Okay, that was number 2. Number 3, I like that. Let's do number 5. And that should be also part of your homework. Okay, number 5. It says the company makes high-end hard-sided luggage for sport equipment. Data concerning 3 of the company's most popular models appear below. So we have ski guard, golf guard, and fishing guard. Selling prices are given, variable costs are given. Plastic injection molding machine processing time required to produce 1 unit is 2 minutes in ski guard, 5 minutes for golf guard, and 4 minutes for fishing guard. So there's a constraint, and the constraint is the machine that we have in here. So it's very important to see how many minutes each of these products are taking time in production. Pounds of plastic pellet per unit, we need 7 pounds here, 4 pounds there, and 8 pounds for fishing guard. Okay. If we assume that the total time available on the plastic injection molding machine is the constraint in the production process, how much contribution margin per minute of constrained resources is earned by each product? So we have the selling and we have the variable. Okay, so let's look at the solution here that I have for you. The selling price for ski guard is $200, variable cost is 60, so contribution margin is 140. Contribution margin for golf guard is 160, but contribution margin for fishing guard is much higher at $200. So fishing guard looks good as of right now. Ski guard takes 2 minutes to get the job done, and that's 2 minutes of machine time. So 140 divided by 2 minutes of machine time gives you $70 per machine minute. $70 per machine minute. Golf guard takes 5 minutes to do that. That's a long time. So 160 divided by 5 gives you only $32 per machine minute. Fishing guard gives you a higher contribution margin, but because it takes 4 minutes, so 200 divided by 4 gives you $50 per machine minute. So as you see, ski guard, even though the contribution margin is the lowest, but per constraint resource, it has the highest profitability per minute of the machine time. Fishing guard is the second, and golf guard is the last one. So production of the ski guard would be the most profitable use of the constraint resource, which is in this case time on the plastic injection molding machine. The contribution margin per minute is $70 for the product, which is larger than the other two, as we spoke. In this part, constraint is the available product. Okay, let's read part 3 and then we'll come back. In part 3 says, how about if we assume that a severe shortage of plastic pellets has required the company to cut back its production because of that supply chain. So much that is new constraint has become the total available pounds of plastic pellets. How much contribution margin per pound of constrained resource is earned by each product. So we have constrained resource of supply chain for the plastic pellets, and we want to know what's the contribution margin per pounds of constrained resource. So here we have the contribution margin for each product, but we know ski guard takes 7 pounds, golf guard takes 4 pounds, but fishing guard takes 8 pounds of plastic. 140 divided by 7 gives us 20 pounds, $20 per pound of constrained resource. Golf guard gives us 160 divided by 4, that's $40. So as you see, golf guard is the best profitability at this point based on this constrained resource. And fishing guard is the second. So in this case, production of golf guard would be the most profitable use of the constrained resource. The contribution margin per unit of the constrained resource for this product is $40, which is larger than the other two. So we need to produce golf guard in this scenario because it has the highest contribution margin first. And then we move to fishing, and then the last priority will be ski. So it depends on your constrained resource that you might have in your company. You might change the production level from one product to the next based on the situation. Good. Okay, so chapter 11, we did number 5. How about we do one more, huh? That will be in your homework anyway. So let's do number 6. Okay. Number 6 is also a constrained resource. It says the company makes furniture, its only variable cost is the direct material. The demand for the company's product far exceeds its manufacturing capacity, so the demand is high. The bottleneck or constraint in the production process is the upholstery labor hours. Information concerning 3 of the company's product appears below. Selling price for recliner, for sofa, for love seat. Variable cost, which is material, $800 for recliner, sofa, and love seat. Labor hours per unit. Recliner takes 8 hours, and we just learned that labor is the constraint. 8 hours for recliner, but 10 hours for sofa, and just 5 hours for love seat. So the company is considering paying its upholstery labor's hourly compensation in addition to their usual salaries to work overtime. So it's a matter of, do we want to go overtime or not? Okay. Assuming that the extra time would be used to produce sofas, up to how much of an overtime rate per hour should the company be willing to pay to keep the upholstery shop open after normal working hours? In second scenario says a small nearby upholstery company has offered the upholstery furniture for the company at a price of $45 per hour. So someone offered to do the job for $45 per hour, another company. The management of the company is confident that this upholstering company has high quality craftsmen, and there is no issue on that part. So how much additional contribution margin per hour can company earn if it hires the nearby upholstering company to make love seats for them? Okay, so let's look at the number 6. Selling price for price per unit for sofa is $1,800. The variable cost is $1,200. That means we have a contribution margin of $600 for sofa. But sofa takes 10 hours of labor time. So 600 divided by 10, it gives us $60 per hour of labor time. The company should be willing to pay an overtime rate up to $60 per hour to keep the upholstery company shop open after normal working hours, because per hour profit of 600 divided by 10 hours of labor, that gives us contribution margin per unit of constrained resource $60. So we have that much room to move. So we should be able to pay overtime up to that limit. Obviously, we don't want to pay very close to that limit, but up to $60 per hour. Now, in the scenario 2 that we have a sister company offering us $45 per hour, the selling price of loft seat is $1,500, variable cost is $1,000. So that gives us for loft seat contribution margin of $500. Okay. 500 divided by 5 hours of labor, constrained resource, gives us $100 per hour per unit of constrained resource, right? $100 per hour. The additional contribution margin per hour earned by hiring the nearby company is for 55. That means this is our profit per hour of labor, right? But if we let them do it, we're going to pay them 45. So 100 minus 45, that gives us an additional still $55 of contribution margin. So the offer by nearby upholstering company to do the job for $45 per hour should be accepted. Why? Because we have still $55 additional contribution margin. The time would be used to upholster loft seats. If this increases the total production sales of loft seat, the time would be worth $100 per hour, right? And a net gain of $55 per hour will be the result right there. So we can let them do it, pay them 45, and we have still $55 left. If loft seats are already being produced up to demand, then having this unit upholstered in other companies would free up capacity to produce more of the other 2 products. Remember, the labor is our constraint. So we can free up our labor and do the other product. In both cases, the additional time is worth more than $45 per hour. So it's a good idea to let them to do the loft seat, which is easy. And the quality of job that they are doing is good. So let them do it, give them $45. We keep the $55. And also we free up our labor. So our labor can do the other products. And what other products we have? We have sofas and we have recliners. And they have also good contribution margin. So we can let them do the loft seat. And we take care of the other 2 in our company using our labor. Okay. Hopefully that helps. That's chapter 11. And I have one more chapter to cover, and that will be next week, okay? Make sure that you finish your project and submit beforehand. Also, we have one exam left, which is chapter 9, 10, 11, and 12. So we are very close to the end of the semester. See you next week, and that will be the last meeting.